G'day, my name's Chris Anderson. Welcome to the Ando & Co podcast. I'm really excited to be sitting down with Mark Wist, who I had a chance to speak to a couple of years ago on the podcast. But today, so Mark runs property resolutions. He's got over 30 years in real estate with a range of different roles, working in both investment and funds and all sorts of things. So Mark, before I fumble that any further, can you give me a quick intro into exactly what it is you do?
Sure, Chris. Excited to be here, and thank you very much for the invite. My background is principally in valuation, advisory, research, and funds management. And so 5 years ago, I got sick of commuting between Brisbane and Sydney and started my own advisory business, which kind of focuses largely on funds management and financial services licensing, but also development management, value management, such as, believe it or not, and feasibilities, and also if you like, portfolio analytics. I run a service with a partner, and we do some heavy lifting for the likes of Sun Super and Victorian Funds Management, Spirit Super, and those guys running the ruler across their portfolios. It's principally around that funds management and general consulting space, built to debt funds for bank lenders, that sort of stuff. So that's kind of the hell of it.
Awesome. I'm really happy I didn't try and tackle all of that. You're obviously very well versed across a lot of areas in real estate.
Well, when you're in it long enough and you get exposed to all sorts of different things, and as a consultant, the primary answer is yes, and then you've got to figure out how.
Absolutely. Yeah.
Can you do this? Yes. Right. Yeah. How can you do it? So you learn on the fly, and I've been exposed to all sorts of really cool stuff as well. Some ASX listed M&A stuff, and across residential, retirement, and aged care, retail, industrial, office, the whole bit. It's really interesting.
Fantastic. And I'm sure we could dive into a whole lot of work with sophisticated investors and commercial properties and a really detailed analysis of what's happening across all of Australia. But what I would love to focus most on today is the residential property market in Brisbane for homeowners and investors. So I guess, can you just sort of run us through what's been happening over the last couple of years, how that looks in comparison to maybe the last 30 years in the market, and also what you're seeing with the impact of everything that's happening at the moment, and maybe some of your expectations moving forward would be fantastic.
Yeah, okay. All right. So, it's the headline acts. You'd had to have been living under a rock to not notice and been aware of the sort of stuff that's been going down, right? But in essence, Brisbane's in a pretty good spot, and perhaps we'll tackle the Olympics a bit later on. But generally, Brisbane has been a bit of a Sleepy Hollow, I suppose, by comparison to the likes of Sydney and Melbourne, and the rates of growth that we saw in Sydney and Melbourne, we didn't really see here when things started heating up just after the coronavirus started. And what we saw was pretty much the opposite of what the larger banks were expecting to happen. Right, it was all doom and gloom, and what actually transpired was a paucity of listings. We had Tina and FOMO, that there is no alternative, and the fear of missing out, which actually drove prices up to extraordinary and unsustainable rates of growth. in those two cities, and Brisbane was a little bit slow to catch on, but then it did, and now it's also a laggard at the other end, coming down much more slowly. So Brisbane is just flattening out now. It's the growth is stabilized. It'll most likely go negative, like we're seeing in Melbourne and Sydney, and that's largely a consequence of the the rates of inflation, and there's a direct linear correlation to the increases in interest rates, even though it's only about a third of the stock of properties that are owned with a mortgage. That's enough to affect the market and create quite a sense of unease in the buying public. When it's difficult to commit to a mortgage when you're not certain how much extra you're going to be paying. A lot of people who have bought a house with a mortgage in the last 10 years don't know what an interest rate increase is, because we haven't had any until now, and suddenly they're going up in leaps and bounds, and suddenly people are having to find hundreds or the odd $1,000 a month extra to fund the mortgage for no particular benefit or beneficial outcome. So with the increase in interest rates that are designed to combat inflation, which is the other side of that double whammy coin, where not only are people having to fund increased mortgage expenses, but also having to pay more for electricity, petrol, food, blah blah blah, right? And so it's no surprise that consumer sentiment is down. I think the latest numbers I saw was down to around 80, which is around about the same as we saw at GFC time and at the beginning of the pandemic. And so it's all a bit of a vicious cycle, and self-fulfilling and self-feeding, and is driving down the demand for residential real estate. But I don't think you see the odd article and a comment around words like crash, etc. I think the market is too stable in this country for us to see a crash as such. Certainly a correction, that's an entirely different thing. And so and that'll likely just unfold as a sort of over the next 6, 12, 18 months, as interest rates increase and then peak, and as unemployment is still low, although I'm not a big fan of the measure of unemployment, but that aside, we still have a lot of people doing a lot of work, still earning money, and still generally able to afford things. And of course, there will be some at the edges who fall over and can't cope, and that's inevitable and tragic. But overall, I don't think we're going to see mass hysteria, masses of mortgagee and possession sales. It's certainly not enough, I don't think, to materially affect the market, at least in the residential space.
And I guess just looking at interest rate rises that are happening, inflation that we're seeing, well, how can you sort of walk us through the growth that we saw over the last couple of years since COVID, and how that actually looks compared to big growth spurts that we'd previously seen maybe over the last 30 years or so?
Yeah, it's a good one. And so there is something in the sentiment and those two cliched acronyms, but they did have a lot to answer for, the fear of missing out, and there is no alternative. the principal problem is that, when we see significant house price growth, and there is really no practical way for those who are saving for a deposit to keep up, because there are absolutes and then there are relatives, right? So relative numbers. So if you're talking about you're saving a proportion of your income, and that might be X dollars, whereas prices are going up X%. That's a whole different dollar amount, right? Much bigger dollar amount. So relatively, you're moving backwards, it's moving further away.
Well, you're probably saving. Sorry, you're probably saving. Let's say you're saving 20% of your income. Houses in Brisbane went up by more than that in a year, and that's 20% of, let's say, 100 grand versus 20% of 800 grand, let's say.
Yeah, so, exactly. Two totally different numbers, and 20% of 100 grand after tax, right? So it's it became extremely problematic, which was that fear factor that really did play a big part in driving prices up, and part of the initial problem was that there was a paucity of stock, and it's economics 101, right? If you've got a lot of demand, not much supply, you have a classic recipe for price increase. It's the only relief valve that you've got, and that's exactly what happened. And so now we've got less demand, a few more properties on the market, and that's kind of why we're seeing the steam come out of the market. Why price growth has basically flattened out. Brisbane, I think, most recently in all, and the last CoreLogic number I saw was like 0.1% positive for the 3 months for Brisbane, but it's still, for the year, it's still positive. It's like 5 or 8% or something growth, like 5 or 8% above this time last year, whereas Sydney's like -6 or something.
Okay.
Yeah, and we, the correction territory, -10, -15, but at the end of the day, when you saw it go up by 20-25%, for it to come back down 10 or 15, it is still plus 10% of where we were 2-3 years ago.
Yeah, and exactly.
It's still a lot more difficult to get into the market for those who aren't in it than it ever has been.
One thing that I'm interested in, I've actually seen it because I'd worked in Toronto real estate. I had a look at the numbers over the last decade, and of course, we've seen that house prices have gone up significantly, and unit prices have started to go up reasonably quickly as well. But what I actually saw looking back over the Toronto numbers was that units have really started to grow almost as quickly as houses, purely because houses are so expensive now, and really there's not much of an option. What have you seen in terms of that trend in Sydney, Melbourne, and I guess at what point could we expect to see that in Brisbane?
Yeah, and that's a really difficult one, because that is that fear factor. It's like, well, if we want to buy real estate, that's our only choice now, kind of thing, right? And so you're right, and places that we're hardly the pioneers in this sector of the market. Just take a look at Hong Kong and New York, etc. Right? But it's absolute fact. But they're in my view anyway, they're two totally different beasts. And particularly here in Brisbane compared to Melbourne and Sydney, the issue is kind of like Perth's office market. It's not especially mature. And so when you get a big lump of apartments coming on the market at any one time, it shifts the needle a lot more than it does in a deeper market like Sydney or Melbourne. If you get like 250 apartments come on, it doesn't really shift the needle that much. Whereas if you get 250 come on here, as a much smaller market, it makes more of a difference, right? And so it affects that supply balance, and therefore can affect pricing. And so you can, I'm sure you could point to any number of anecdotal transactions, and I know of a few myself. where the asking prices in the last year or so for an apartment in Brisbane is little different to the asking price 5, 6, 7, 8, 9, 10 years ago.
Mm-hmm.
And that absence of capital growth is simply a factor of one major and one minor factor. The minor factor, I think, is that there are a lot of additional costs associated with the apartment ownership,
Mm-hmm.
body corporate, that sort of stuff, um, and um, and also that supply demand thing that has really stifled apartment capital growth in Brisbane. But as you pointed out, it's kind of now it has been coming back, and I
Mm-hmm.
think it's that Tina thing. There is an alternative because there were so few houses on the market available to buy that attention kind of turned to mopping up some of that supply in the apartment space, and it's kind of done the job really. It's been a bit of a win for everybody
Mm.
involved, and kind of supported that part of the market much more than it would have done otherwise. And this whole coronavirus thing um, has been such a wrinkle, and it's been a, a major source of misaligned um, uh, uh, um, outcomes. For example, in valuation theory, never once in any book ever did I read about adjusting for what happens when you take away the people from property, in office and retail in particular, because it
Mm-hmm.
just wasn't
Mm-hmm.
a concept that you ever thought about until it
Yeah.
actually happens. And so it's really thrown a big spanner in the works.
Mm. And I guess what, like, we've covered off on units, and obviously the other option that you have, if you can't buy sort of inner city houses because the price keeps going up, how have you seen the growth on sort of the outskirts of Brisbane? And I think particularly people have been looking at like Logan and Ipswich and those sorts of markets that
Mhm.
have seen really good growth over the last couple of years.
Absolutely. And look, I took a trip out to Yarrabilba, the Lend Lease, the big Lend Lease master plan, not more than, I don't know, 2 months ago,
Mm-hmm.
and to kind of retrace my steps from a similar journey that I took about 3 years ago, and
Mm-hmm.
and visited the sales office there and asked the same sort of questions. And about 3 years ago, you could um, basically pick whatever lot you wanted, and almost negotiate terms within reason. Right, the Lend Lease runs a pretty tight ship when it comes to their covenant, but there were plenty to choose from in various staged releases then. And then wouldn't have been more than, I don't know, 2, 3 months ago, I went out, asked the same questions, and you go into a ballot, and you're lucky if you get a piece of land now out
Wow.
there, and that's a remarkable difference, um, for a master planned community being delivered over 30 years that will house like
Mm-hmm.
50,000 people and have like 20,000 lots or something. To have to go into a ballot, that's something. Um, and going further afield a little bit, the, the whole tree change thing was massive as well. With the whole commute, work from home thing, where people thought, okay, well, but I don't have to be in the office 5 days a week anymore. I can move a little bit further away, and I can tolerate going into the city 2 days a week and
Mm-hmm.
spending an extra half an hour each way, kind of thing. Right? And that became real, and the regions did really well out of it. But I think what we're just starting to see now is that trend just reverse a little bit.
Mm-hmm.
And I think part of the reason for that, it would, and this is my understanding of it so far, that part of that kind of migration change, if you like, from city focus to kind of regional focus, and probably more so in Victoria and maybe New South Wales and to a point Queensland, was the kind of the Gen Zs and millennials, etc. They were kind of the ones who were making that shift a lot. Might be a bit of a generalization, but
Mm-hmm.
what I think has transpired is that there's a realization that yes, that's great, and yeah, we can get, obviously you can get a lot more bang for your buck. If you're moving out to Melton in Victoria, or further out or whatever, but when you're out there, you realize that it's the nights are kind of cold and a bit lonely, and when you're not in the office and you're not learning from your older colleagues and you're not getting involved in the action so much, there might just be just a little bit of kind of regret's a strong word, but recalibration maybe about the thinking around that, and so I just wonder if the strength of that movement and demand might just kind of unravel a little bit and refocus, start to refocus a little bit towards the cities.
Have we seen that? Just thinking about, because the last time we caught up, we were sort of talking about the value of cities and people that are all in a similar industry being able to have access to one another. Are we seeing maybe in a big city like New York that people who moved away are coming back yet? Like
Yeah,
people who thought that would be the right idea, they're changing their minds.
Yeah, I think that's the case, and it's not it's not necessarily across the board, but I think there is an undertone of how am I going to get ahead in my industry? How am I going to learn? How am I going to get the breaks in the industry that I'm looking for, whether you're a lawyer or a financial advisor or whatever. If I'm not here, if I'm not in the middle of it, if I'm not in the thick of it, and my face is only seen once or twice a week, how am I going to do that? I'm not special anymore. I kind of need to be in the thick of it, to get in the action and get the big jobs, etc. So yeah, I think that will be a driver for some of that relocation and focus out in the regions to kind of come back to the urban area.
Yeah, it'll be interesting to see how it will play out. And I guess
absolutely.
And it's while no one can catch up during COVID, it doesn't really matter that you're going to be elsewhere because no one can catch up anyway. But suddenly when everyone, like all those work meetings that aren't really a work meeting during work hours, but when a lot of the connection happens outside of the hours, you're not available for that.
Yeah, exactly right. Yeah. And there are those social events where you go and grab beer out of your own fridge and sit in front of your computer, and everybody else does the same thing, and it's sort of like that closing scene out of the Muppets, right? When you've got like 20 or 50 people each in their own little box, but it's not that same convivial atmosphere. And I'm no psychologist, but when you've got 20 faces staring at you, basically you've got one conversation going.
Exactly.
Among 20 people, but if you're in a room with 20 people having a beer, then you're going to have like 6 different conversations with 3 people in each one, and kind of just moving around, and that just it's a totally different dynamic.
And I think the one thing that happens out of being at events like that, it's quite often the conversations that you didn't expect that stand out to you at the end of the night. or at the end of
Yeah,
the day,
yeah,
like you was
absolutely.
with the person that you
Yeah,
might not
and
have otherwise have thought to speak with, that suddenly you're like, oh wow, I didn't
yeah,
believe that you did that, or something along those lines.
yeah, absolutely. And it's those little discoveries, and it's that classic water cooler thing, right?
Mm,
And it's a cliche for a reason.
yeah, and I guess, what are your thoughts on? Obviously, there's if you're working for a big company, you may have some options moving between a Sydney and a Melbourne and a Brisbane, and it's clear that Sydney and Melbourne are ahead of Brisbane at this stage. But with events like the Olympics, like is it likely in your mind that we could somehow catch up, or what are your thoughts?
Yeah, the Olympics is a funny one, and I've read some research around this.
Mm-hmm.
Um, that uh, uh, those areas that benefit specifically long term, forget about the few weeks either side of the Olympics where they go gangbusters and you charge 5 times market for the stuff, right? But
Mm-hmm.
longer term, um, it's really only those properties that are specifically benefiting from the additional infrastructure
Mm-hmm.
that benefit long term. So in Brisbane here, we've got a massive news station next to the Wollongabba or the
Yeah.
Gabba um, sports stadium, right? And that's the centerpiece of the Olympics, where
Mm.
the running track and all the rest of it will be, right?
Mm-hmm.
Um, and we've got that massive crossrail. Um, no, that's the London one. What do we call it here?
Cross River
Um,
Run.
Cross River Rail, yeah.
Yeah.
Um, um, you know, and so that will benefit the Wollongabba precinct a lot,
Mm-hmm.
right? So we're going to
Mm-hmm.
see a lot more residential, high-rise residential, popping up out of those car yards that sit along Ipswich Road,
Mm-hmm.
kind of thing, right? Um, and a lot more retail, a lot more um, uh, cool stuff.
Mm.
Um, but how is it going to affect you know Indooroopilly or Springfield or to be honest, well, in my view, it isn't really.
Mm-hmm.
And the major advantage, one of the major advantages, there are two, I think, that Brisbane has had in the last few years is one, its relative affordability compared to Sydney and Melbourne,
Yeah.
uh, and two, that inevitable lifestyle comparison.
Mm-hmm.
Um, you know, and um, I can vouch for that. I've been lucky enough to live in all three, and there is a material difference between them all. And in my view, it's a real thing, right? That lifestyle difference between Sydney, Melbourne, and even those are a bit different, but certainly Brisbane is much more different. And so the point is that if we start to catch up to Sydney and Melbourne, then it kind of dilutes the beneficial difference that we have in the
Mm.
first place, and it's
Yeah.
kind of
Yeah.
counterproductive, self-defeating.
Mm-hmm.
Um, and so there isn't much we can do about um, uh, defending against that because it's going to happen one way or another, right? Um,
Mm-hmm.
if it does happen, then it's going to happen no matter what we try and do, apart from instituting um, bigger taxes or some other set of policies that discourage inward interstate migration.
Mm-hmm.
But um, are we going to catch up in terms of absolute numbers? Probably not, because at the end of the day, Melbourne is going to overtake Sydney as Australia's biggest city, 5 million odd people, and we're at 2, right? So it's not going to happen in our lifetime, and it will take. Will it ever happen? Well, who knows? But not in the foreseeable future. And that'll mean, I think, structurally and systemically, Brisbane won't catch up to the sorts of numbers that Sydney and Melbourne have in terms
Mm-hmm.
of relative value and prices.
Mm-hmm.
And that kind of reinforces the relative um, value difference. And value proposition that we have here, right? So you can get 500 square meters and a nice house in a nice suburb for $1 million, and in Sydney or Melbourne, the equivalent thing, you're paying at least 50% more.
Yeah, and in your mind, that sort of, well, obviously warmer client, that's not going to change, but also people not necessarily needing to make as much money in order to be able to afford the lifestyle means that it can be a little bit slower than Sydney or Melbourne. So if suddenly it became particularly expensive, then you miss out on that.
Yeah, exactly right. And I guess the counter argument to that is that notwithstanding all of those benefits that Brisbane has, the risk that Brisbane has is the floods and natural disasters of the like, right? And that will naturally put some off coming up here. And I had a bit of a look at the frequency of flooding events, major flooding events in Brisbane, going back to like 1840-ish was the first one, and the frequency is increasing, right? And that old 1 in 100-year flood thing is, in my view, and I'm not any kind of geoengineer or anything. I just have a lay view, but it's it will happen more frequently now. In fact, just sort of taking a logarithmic approach to it suggested to me that after the floods that we had here in Brisbane in March, the next event similar to that is due in 2025.
Yeah, right.
Just taking the pattern, right?
Yeah.
Obviously, nature is going to decide that, but just taking the increasing frequency in the pattern, and at the same time, I had a bit of a look at Australia's biggest insurance event and adjusted them for inflation, right? Because the Sydney hailstorms in '99 or '98 or something, still the biggest one. But adjusted for inflation, 3 Brisbane floods are in the top 6, I think, insurance events in Australian history. And in fact, the flood that happened a few months ago caused more inflation-adjusted damage than the much bigger flood that happened in 2011, just because property is worth more now than it was 11 years ago.
Yeah. Okay.
And so that's just going to keep happening, and getting insurance now is starting to become problematic in Brisbane.
Mainly in flood affected areas or in general?
Mainly, but because of all of these floods and fires and all the rest of it, we've seen a lot of insurers pull out of Australia altogether, right? And so, and this goes to professional indemnity insurance as well, but general insurance, right? We've got a lot fewer insurers in the marketplace now, which means the premiums are going up, and that affects absolutely everybody, not just those in the flood affected areas. And to the point where people will start to self-insure, and if the worst happens, there could be cataclysmic loss.
Interesting. And I guess moving away from Brisbane, people who are potentially moving up from Sydney and Melbourne, are you seeing, before we jump into it, are you seeing that as quite a real thing? Like you're seeing, as far as the data you're looking at, there's quite a lot of it happening, and it's increasing.
Yeah, absolutely. Yeah, thousands and thousands.
And I guess the next thing, we saw the Gold Coast really take off over the last couple of years.
Yeah.
How does that compare to Brisbane? And I guess, do you see the Gold Coast catching up to Brisbane?
Look, you know what? That's possible, because just like Brisbane is smaller than Melbourne, Gold Coast is smaller than Brisbane, right? It's about a quarter of the size, give or take. And the housing stock is kind of it's there is very little in the way of vacancy uh, in the Gold Coast area,
Mm-hmm.
and that just like I said before, that's the only relief mechanism is increasing prices, whether you're talking rent or price.
Yes.
Uh, and so it really is not beyond the realms of possibility that the Gold Coast can catch up to Brisbane. And we're talking about the same kind of drivers, right? Even between the Gold Coast and Brisbane, right? Brisbane
Mm.
doesn't have a beach, for example,
Mm-hmm.
right? And
Mm-hmm.
and the Gold Coast does.
Mm.
Um, and same goes for the Sunshine Coast. It's just that little bit further away, but it's possible to commute, a couple of times a week, Gold Coast, Brisbane, and it's a different lifestyle. And it's as say as Brisbane is to Melbourne, the Gold Coast is to Brisbane, um, in terms of lifestyle. And so, all
Yeah.
of those factors, and a lot of the people that I'm aware of, I spoke to two of them at one conference that I was at just a few days ago. Two of them had moved up from Sydney to the Gold Coast, uh,
Mm.
and I think that representative of a bit of a trend. I mean, why move to Brisbane when you can have an even better, well, better,
Yeah.
sort of
Yeah.
a qualitative assessment, but lifestyle on the Gold Coast. Travel up to Brisbane a couple of times a week to kind of the satellite office there, work from home, go surfing in the morning, and all that sort of stuff that you can't really do in Brisbane.
Yeah.
Uh, it's a real threat to Brisbane, that in terms of inward migration from Sydney and Melbourne in particular.
Mm. Yeah, that's interesting. And I guess so. I know that you've got another meeting coming up shortly. I just want to give you some time. But apart from what we've covered already, is there any other trends that you're seeing in relation to that sort of Southeast Queensland market?
Uh, well, yeah, certainly plenty in the financial services space. But I guess one of the things actually, talking residential property, is a bit of an elephant in the room that we haven't touched on yet, and that's property
Mhm.
development.
Right.
And um, so I'm kind of in the middle of trying to help a few developers with a few things, including debt, and it is becoming extraordinarily difficult now. Uh, and it's not news that we're seeing profitable builders in particular fall over left, right, and centre just
Hmm.
because of the labour shortages and the price increases and the impact of previously set fixed price contracts, because they were the norm, right? Everybody
Hmm.
did fixed price, and it was fine when timber was going up 1, 2, 3, 5% or whatever per annum, build that in. But suddenly when you're getting timber going up 20, 30%, concrete not being available, being 35% plus, we're seeing build costs, and one that I'm involved with at the moment, where a feasibility was prepared, and it was professional feasibility, um, and that I saw, and the first price came in 35% over the top, and that just destroys the feasibility. And so that group already has bought the land with the expectation of building on it,
Hmm.
and suddenly that it's a whole new ball game, and the builders are also not committing to fixed price contracts, and it's irresistible force, immovable object, because they're saying no to fixed price contracts, and the banks are saying, well, we're not giving you money unless you have a fixed price contract. Um, and the poor old developer is stuck in the middle, and even to the point now where, with the increases in interest rates, where the debt equity proposition is changing to the point where suddenly equity may actually be a cheaper option than debt, which is just
Wow.
preposterous a few years ago, and completely contrary to to economic fundamentals, and this whole thing, just like valuation theory has been rewritten by COVID, this is kind of rewriting property development, um, and it's changed massively in the last 6 months, really, and so the upshot is that bringing residential stock to the market is starting to become problematic now, and for all sorts of reasons, costs and also the availability of debt finance, and that's going to sort of throw a bit of a spanner into the supply chain, where a lot of the new demand coming from those Sydney, Melbourne markets, and natural growth as well, and also, sadly enough, of course, always the divorce rates and that sort of stuff, where one household becomes two, and that's another source of demand, can't be accommodated by the supply of new dwelling apartments or houses as easily, because they're just too expensive to build and deliver, and the builders and or the developers can't get access to the capital they need to deliver them, and so this is kind of an unfolding issue right now, and is likely to become a real, sort of choke on the supply chain, in the next sort of 3, 6, 9, 12 months, that will have, consequences in prices again, that will go back to supporting and underwriting prices, to the extent that it's that it becomes a problem. And that sort of proposition that there just isn't going to be a crash; it'll just be a natural unwinding of some of the growth that we've had.
Well, I guess we've seen the price of used cars go up because you couldn't get your hands on new cars.
Yeah, quite.
So I guess we've spoken about the possibility that things become difficult in the residential market, but would you expect, given that you can't bring new stock on, that potentially existing stock gets a boost?
Yeah. That's a natural consequence, I think.
Fantastic. And I guess before we wrap up, you're speaking to property developers. I expect property developers are open to looking at all markets. Where are they currently developing, or at least wanting to develop across Australia?
Well, the brutal answer is anywhere they can find a piece of land that makes feasibility. But of course, that's primarily both driven by opportunistic acquisitions, so wherever they can get a hold of a piece of land, but also it needs to be supported by things like population growth, and access to infrastructure, schools, shops, all that sort of stuff. So that's everybody understands that, and there's no magic in that. It is what it is, and the other is fact.
And so, I guess, are we seeing somewhat of a trend that they're considering Southeast Queensland more so than they would previously, or how does that look?
Yeah. This is a national problem. This the pricing thing. So it is everywhere. And the banks are much they're discriminating much more, and to the point where they have areas that sort of like green, grey, and black, right? Good, okay, and no thanks. And they will want to, just like a developer's feasibility, will want to see the metrics pointing to the right outcomes, so that they are confident that they get the pre-sales and also get enough sales that they can complete and pay out what will be a capitalized debt facility mostly. And so they'll need X% of those pre-sales before they'll fund it. And it's that system is no different now to what it ever has been. There's just a lot more pressure on it now. And it's kind of in that negative feedback loop, with investors kind of a bit hesitant and not sure if they can get their bank finance, and even those who have committed to put the deposit down. I think we'll see a few that have to walk away from their deposit because maybe the valuation has come down, and that'll breach LVR covenants, and that'll cause some distress to everybody. And that unit goes back into the pool for the developer to sell again. Great, they get their 5-10% deposit to keep, but they're selling it back into a more difficult market. It is a negative feedback loop. But that's not going to last forever. It's just a difficult time right now, and there have been a few trigger events, COVID, Ukraine, and those sorts of things that will sort of wind their way out of the system. So inflation, it's a relative, not an absolute thing. So in a year's time, we've seen petrol go up, I don't know, 50% or whatever. And by the time that falls out of that annual CPI calculation, CPI will be back down to 2-3% manageable, and then there won't be any need for the RBA to be cranking up its interest rates, and it'll sort of calm down a bit. Interest rates will stabilize, and the sentiment will return, and it'll all kind of be back to happy families, but I think prices will stabilize at a higher rate than they were going into COVID, and the natural 3-4-5% per annum growth that we were seeing, 4 years, we might have seen plus 20% over those 4 years normally, and they'll probably stabilize, plus 30 or 35 or something. They'll stabilize higher than they would have been had you just drawn a straight trend line across those 4 years. But notwithstanding that there's going to be a dip in the middle for everybody, including Brisbane.
All right. Well, I appreciate you've got a meeting to go to now. So thanks so much for your time and your very detailed analysis. So I really appreciate it. I look forward to speaking with you soon.
I'll look forward to it too. Couldn't be more of a pleasure. And thanks, Chris.
Thank you.